Let's look at a question of macroeconomics, which is about monetary and fiscal policy. So the question that you can get in the exam would have a recent meeting of Federal Reserve and some of the discussions. They might just ask you to a one-liner question, or they might give you a caselet if it's a big question and there are multiple questions out of that. So let's look at a recent update to help us understand what's going on in the market and the kind of question on Federal Reserve economics, macroeconomics that you can get. So this is about a meeting that happened on 20th September. It says that three Federal Reserve policymakers argued on Saturday for lifting the central bank's key interest rate before the year end, countering bets by many traders that Fed will wait until 2016. So there is a discussion about increasing the interest rate, laying out the rationale for interest rate cut. Now, this is how where we link what we read in the book of what is actually happening. So people who say that you should increase the interest rate says that you have a good domestic economy, you have low unemployment, and they should overshadow concern about volatile financial market or global slowdown. Uh, but what happened was the rate remained unchanged. So they are discussing and they are talking about argument against. So uh, while Williams voted to leave rates near zero, Bullard, who does not vote in the policy, argued in favor of rate increasing. I argued against the decision and created rather than reduce global macroeconomic uncertainty. Essentially, and there is an upward pressure, so global economic finance, medicine, economic activity are likely to put further downward pressure on inflation. So there are arguments pro and against. One of the argument was that even if the unemployment rate is low, which means that economy is doing very good, but even if there is very less uninflation, there is no inflation in the market, so why should we reduce the rate? Because inflation is one thing where why should we increase the rate? Because generally in countries like India or the developing world, you increase the interest rate primarily to reduce the inflation, because that's where it becomes most important. So it's like the inflation is very low in spite of the low interest rate. So like India has a 10% inflation at an 8% of interest rate. So they don't reduce the interest rate because they think that the inflation would go beyond 10%. So they say that the inflation is not that bad. The other thing that they argue is the value of dollar. So they say that what happens if the dollar goes weak or strong when we increase the interest rate, and they conclude that this is a closed call because there were equal people on both direction. So that was about the news. Let's look at the question, a liner question and a caselet that you might get on the current meeting if you are giving the exam in recent times. So a minor question would be to find out real GDP, where you will be given a base here. So a real GDP, as the name suggests, is something very opposite to nominal. So nominal GDP would have an effect of inflation. So for example, if you say that your GDP is 100 and after 1 year you say that your GDP is 110, but you say that that's nominal GDP and inflation is 10%, which means that you are still producing the same goods, only the price have increased, which does not makes you more efficient or grow. It's just the price that increased. So we keep price constant and we multiply with the constituents with the quantity of the constituents to get to the real GDP. So on the table down on the southwest, you see the real GDP. It's the sum of all the constituents that comprise of the GDP. And then they would ask us whether we should take expansionary fiscal policy or contractionary fiscal policy, or expansionary monetary policy or expansionary fiscal policy. So for example, if you are following the news, the Donald Trump, the president candidate, says that you should have an expansionary fiscal policy by reducing the tax, because increasing the tax is demotivating the business and they go out of the state. So that's a way in which the fiscal policy change would affect. So you could do the same thing by two ways. So for example, if you If you reduce the tax, that would come out at the cost of reduced government spending, because government will have no money to spend, but that will spur up the economic growth, so you don't have to use the monetary stimulus. So those are the two ways to stimulate. And they could ask you whether it's an expansionary or contractionary, and whether it's a fiscal policy or it's a monetary policy. So they're asking us that if the real GDP in this question, for example, is 5500, should you have an expansionary fiscal policy? So since your GDP is lower than the real GDP, which means that you are in a recession, many people are not working, or you're not you're not producing when you can, and things like that. So you would say that you will take an expansionary fiscal policy, which would be like reduce the tax so that companies start doing the business, because there is resources, there are people around who are not getting job, and so on. And the other question, should you take an expansionary monetary policy in 2014? So again, in 2014 the real GDP is 504, which is less than the full employment GDP. Again, it means the same thing, that the economy is in recession, so you can reduce the interest rate and ask people to borrow the money and do business. So till the time the GDP is lower than the full employment GDP, you can take the expansionary route, either by the fiscal way or by the monetary way. So you can get these kind of questions, and if they want to link it with the current news, they'll talk about a meeting and the rationale people are giving to talk about different things, and they might ask whether this rationale is under the fiscal policy or the monetary policy. So expect this kind of a question.